Hello, ladies and gentlemen. My name is Raymond, and today we're going to go over different entity types and what they mean exactly. I've seen a lot of poor advice given by bookkeepers and CPAs and other accountants alike about how someone should form their entity when they're starting their small business. And there's a lot of different benefits to different entities. And one thing CPAs and accountants tend to miss is the legal structure aspect of it all and the asset protection side of it. I believe one of Robert Kiyosaki's advisors even once said that CPA stands for Can't Protect Assets. But that aside, I wanted to go over what exactly these are. So let me go ahead and minimize this, and just to let you guys know, I'm not a legal advisor or a tax advisor that is licensed in any state or in this country. So please understand, everything that I go over in this video is for educational purposes only. Alrighty, and here are the list of entity types we're going to go over today. So as you can see here, we got sole proprietorship at the top, general partnership, limited partnership, and so on. What we're going to do in this little exercise is I want you guys to pick out either your entity or one or two that you're interested in starting one day, and decide, is it a tax structure or a legal structure? And in some cases it could be both, so just keep that in mind. I'll just give you a few seconds here to go ahead and decide what you think it is, and we'll reveal the answers here shortly. One thing I will say is, if there are any entities that you don't see listed here, please reach out to me and we'll see if we can talk about those as well, if you're interested in talking about those. Alrighty, so I hope you've had time to decide what your answers are here. I'm going to go ahead and reveal them. So sole proprietor is actually both a tax structure and a legal structure. The sole proprietor is responsible for paying their taxes as an individual. They also have self-employment taxes, which we'll go over a little bit in a moment. And then the legal structure is, you're responsible for everything that you or your business does. You could set up an EIN and a DBA as well, doing business as another name, under a sole proprietorship, but still be just as responsible as if it were under your own name. Tax structure would be exactly the same. It's still going to be your tax return. General partnership, we'll go into a little bit more detail about the partnerships and the other entity types, but just know for now, it's actually not a tax structure, and all three partnerships right here are not actually tax structures. They are legal structures, however, and we'll go more into that in a moment. S corporation, this one is a pretty hot topic lately for small businesses, and we'll go into that a little bit more. And unfortunately, there is some advice given that doesn't quite consider all the factors in switching to an S corporation from a sole proprietorship, and switching to an S corporation from other things as well. But the most common is going from sole proprietorship to S corporation. And I want to go over a few of those misinformations, or maybe I should say, underinformed decisions. Because CPAs and EAs do tend to push this because they do have great tax benefits, and they're not doing anything wrong. They actually have business owners' best interests at heart, because they believe the best interest is the money. There are certain legal aspects of S corporations that they don't tend to consider because they don't really see it from that angle. So it's important to know the difference. Even professionals can miss things from time to time, even if they're very well informed in S corporation tax law. They might not know much about the legal side of it all. And even though it's not a legal structure, there are two different ways to set it up. So one is through a C corporation here. You can set up to be taxed as an S corporation. Not if you're publicly traded, of course, but if you're small enough and you're not wanting to be publicly traded, you could elect to be an S corporation, and an LLC could also elect to be taxed as an S corporation. So let's go ahead to the next one on the list here. C corp is a tax structure and a legal structure. An LLC, we'll go ahead and combine these two together a little bit. An LLC is not a tax structure, and there's a lot of misconception about this one as well, because a lot of people think that an LLC is how you're being taxed. You can't be taxed as an LLC. There's no such thing. An LLC can be taxed as pretty much one of these other four entities here. So you got your sole proprietor, general partnership, and S Corp and C Corp here, and it's pretty good. It's actually, I really love LLCs. They have a lot of cool benefits to them, and we'll go over that in a little bit in a moment too. Next is the trust. So the trust is actually a tax structure and a legal structure. These are a little bit confusing for me, at least. I don't really work with too many trusts. There's not a lot of bookkeeping in the trust world for me at this moment. However, the more informed I get, the more I'll gladly share with you guys as time goes on. But I know they're great asset protection structures, as well as great tax saving structures, especially in estate planning. And we'll touch on that just a little bit in just a moment. A B corporation. Now these are brand new. I think these are the newest one on the list here. Yep, they are the newest one on the list. A B corporation is the same as a C corporation. It is actually a C corporation. The B stands for benefit, so it's a benefit corporation. The difference in a B corporation and a C corporation as a legal entity is who the managers are most responsible for. So in a C corporation, generally they need to make the most profitable decision for their shareholders. They need to put their shareholders first, generally speaking. Of course, there's certain environmental controls that they have to meet as well. So as long as they're law abiding, they have to put the shareholders first. The B corporation, however, they put other things first that normally you would find in a nonprofit. However, they do want to be able to make a profit. So in a B corporation, it could be humanitarian, it could be environmental, it could be educational, it could be any of these other things that help the community out or the environment. And they put those before the shareholders generally. They still have to put the shareholders up there near the top. They still want to try to create a profit for them. However, they're not the top responsibility or the top focus. So when it comes to shareholders suing C corporations because they didn't have their best interests at heart, that gets avoided here in the B corporation because their best interest isn't, the shareholders' best interest isn't necessarily the top priority. Next is the nonprofit, and this is a tax structure. I'm sure all of you already suspected it was a tax structure. Some of you might have said it's also a legal structure. The reason why it's not quite a legal structure is because it can be set up as other entities legally. And let's just go ahead and pop it out here in PowerPoint. All right, so you can see here we got sole proprietor at the top. I've rearranged the order a little bit for the slide part here because the way I had it set up originally didn't quite make sense. So let's go ahead and go into sole proprietor here. So advantages, tax advantage of a sole proprietorship. Actually, this is going to be your highest taxed entity besides maybe a C corporation. Now, a C corporation has that double taxation, as you may remember, but depending on how you have your benefits set up with a C corp, it's possible to actually pay less in taxes with a C corp than a sole proprietorship. But let's go into sole proprietor here. So easy filings is what I put for the main tax advantage, because it is just you filing taxes as yourself, as an entity that rolls through to yourself. So it's not too bad. The legal advantage, and I really had to dig for this one, unfortunately. It's not really too many legal advantages to a sole proprietorship, but one advantage that it has over the general partnership, at least, is that there's only one owner responsible for all the decisions and only one owner liable for any incidents that happen with the company or even in a personal life. So, and that's the other part, is the person and the business aren't really separated. So whether you have a car accident in your own personal life, personal time, or if you have a car accident while you are working, in either case, the plaintiff could come after either one in a lawsuit. So Just something to keep in mind, especially for those of you that are risk averse. Now back to the taxes here. The primary focus here on the sole proprietorship, and the main reason why a lot of people, CPAs and tax advisors, want people to move from sole proprietorship to S corporation tax status, is this high Social Security and Medicare tax rate. As an employee, you might have noticed that you get taxed at 7.65%. That's because you pay half and your employer pays half, but some argument could be made that you're paying for half because the employer could be paying you more, but we won't get into that here. The 15.3% is going to be your responsibility as a whole because no one else is paying the other half on your behalf. So just keep that in mind if you decide to stay as a sole proprietorship on how it affects your taxes and also your asset protection and liability, personal liability for your business actions. Next, what I want to go through on this list is the ability for it to maneuver as one of the advantages, as well as the low startup costs here. Low startup cost is probably the number one reason people start off as a sole proprietorship, and that is probably okay in many cases, especially if your business is low risk and not likely to get anyone hurt. Maybe you have some kind of e-service where you don't have to worry about ruining someone's reputation or anything like that. Maybe you just do some data entry for something that's not too sensitive. It just really depends on the business, and that's going to be up to you and your legal advisor to go over. But the important thing is that you do want to determine some thresholds for when you want to move into a less risky entity, such as a LLC or an S corporation or a C corporation even. Just make sure you determine those thresholds, and I would highly recommend determining both a financial and a risk-based threshold. So financial, maybe you want to make $40,000 in profit before you switch, or a risk-based, which might not even take into consideration the financial. Maybe there's a certain point where you realize that the risk is just too great, and maybe you're making $20,000 in profit or $10,000 in profit, and the risk is just higher because you have more employees or you're working with higher profile clients. Just depends on your business. Next, let's go ahead and take a look at general partnerships. So as I mentioned earlier, the general partnership is the riskiest on the list as far as business entities go. And the reason why is because it's basically the risk of a sole proprietorship multiplied by however many partners are in the partnership. So you're not only responsible for your own actions, you're also responsible for your partner's actions. So if there is a lawsuit against your partner, then they could come after both of your assets in a general partnership. Or another thing that could happen if you have a general partner, you can be responsible for a lease that they signed up for that you didn't even know they signed up for, or you didn't have any say-so in the sign-up of the lease for your company. And another problem with the general partnership is they are actually quite easily to be formed. So you might not even mean to form a partnership. You might just say something that intends a short-term kind of coalition, if you will, and it could legally put you into a partnership depending on your state's laws. So just keep that in mind as well as a sole proprietor, because that adds just a little bit more risk to the sole proprietorship than what we just went over in the sole proprietorship slide. Next on the list here, I have the personally responsible for your partner's actions, which we just went over. However, it's very important that you understand that you could be personally responsible for anything that they do that is unethical or illegal, or even contract binding. And if your partner decides to run away, they could run away to another country or move across the country. The state's most likely going to come after whoever is the easiest target, which could very well be you. And these are the reasons why you will see that I put in the legal advantage section here that there are none. Also, the tax advantage is NA because it's not a tax structure, and each partner can be taxed on however they set themselves up. So it just depends on how each partner decides to be taxed. It's not one taxable situation to match both partners per se. Now, if you're both sole proprietorships, then yes, you'll both be taxed as sole proprietors, but each individually, you'll basically get a 1065, which is similar to a 1099, and then you will file your taxes based on that, each of you individually. The legal advantage really just goes to the least ethical partner, and that is very unfortunate and a sad way to put it, but it is the truth. So do whatever you can to avoid a general partnership, and the best way to avoid a general partnership is to avoid a sole proprietorship. So let's go ahead and continue down the list here. Next in line, we have the C corporation, which has a lot of great advantages, especially if you're a larger business. For smaller businesses, it'll still have some advantages, but it may be less profitable, especially starting out. But if you're expecting to grow, it's okay. It's fine to start off like that. Or if you're at a high risk, in a high risk industry, then it might be good as well to stick with a C corporation. If you are a single owner C corporation, only one shareholder in the corporation, then I do want to let you know, even though it's last on my list here, that Nevada is the only state with charging orders for a single owner C corporation. And what charging orders do is they prevent someone from taking all of your assets in a lawsuit or a credit collection. They can only take portions of the distributions that your company is giving you. And of course, you don't actually have to have your business in Nevada. As long as you form it in Nevada, it will still go by Nevada state law. So just keep that in mind as well if you plan on running a riskier C corporation by yourself and owning it by yourself. But there are other reasons why you might want to form a C corporation other than the ones I had listed here. Another one I can think of off the top of my head is if you have foreign owners that you want to have as part owners of your business, it's a little bit easier with a C corporation in some cases. Of course, there are plenty of other advantages to having a C corporation, I'm sure, that I haven't mentioned here and don't have time to mention in this video, of course. One other advantage I can tell you about right now is the fringe benefits deduction, and that is for the fringe benefits you provide your employees as well as yourself are now going to be deductible in this type of setup. Something I wanted to point out here, though, for the liability side was that the CEO and or CFO could be personally liable for any type of contracts they sign, or if they have any type of misinformation, financial records, anything like that they signed off on. And they could actually serve jail time even for certain incidents involving fraud or negligence. So just keep that in mind. It's not 100% safe, nor is any of entity that's on this list. So let's go down the list. Next is going to be the LLP, the Limited Liability Partnership. Now, the Limited Liability Partnership, I actually haven't ever worked with one myself. However, it does seem to work very similar to a C corporation. So Limited Liability Partnership is everyone works almost like a shareholder, and in theory everyone is only limited to the extent that they have invested into the company. Sure, there are certain ways to pierce the veil, and I'm sure it has been done in the past. I didn't get to look up any case laws for this. It's just not a very common entity. This is going to be the opposite as far as partnerships go. This is going to be the opposite of a general partnership, where a general partnership everyone is liable, and a limited liability partnership no one is liable in theory, of course. Next is going to be the mixture, and this is one of my favorite ones besides an LLC, the limited partnership. Now, a lot of people get the limited liability partnership mixed up with the limited partnership because they're similar in acronyms. You got LLP versus LP. But the limited partnership is actually a mix of general partners and limited liability partners. We just call them limited partners here. So the limited partners are only limited to the extent of what they invest into the company. So they could lose everything, just like if you buy a share of stock in a C corporation, you could lose the entire investment. but you're not going to lose your personal assets because the company shut down or got in trouble. Now, a general partner will be running and managing and making the decisions for the company, and they are liable to an extent. There has to be at least one general and one limited partner in order to form an LP. So you can't just have two general partners and call it a limited partnership. You're going to have one limited partner. And this one actually just provides a lot of great advantages. So let's start with the legal structure of it all. Since we've already kind of touched on it a little bit, I just wanted to come back to the general partner being liable. So as I said, the general partner could very well be liable personally for any type of misconduct or lawsuits or even debt that is incurred by the business. However, the general partner does not have to be a sole proprietor. It could be set up as an LLC or a C corporation. And that's important to keep in mind in case you do have a risky business that you want to form an LP in. You might want that extra layer of protection. Now, the limited partner, as I mentioned, is just limited to the amount they invest, and that is because they get no say-so in how the business is managed, at least after the contract is signed and the partnership is formed. They do get some say-so at the very beginning. In that case, it's usually about how the finances are structured and how they're going to get paid back their money that they put into the business. Another good thing about limited partnerships are the estate planning aspects of it. So let's say you have a business as a sole proprietor LLC or an S corporation LLC, just some type of single member LLC. And you decide that you want to leave your business to your son one day. And let's say your son is only about 15 years old. So he still has some high school left, still a little bit immature maybe to run the business, and has zero experience possibly in business. So what you want to do at this point is gift him limited shares of your business, and he can actually own percentages, high percentages even, of your business without actually having any control over the business, because you will maintain the general partnership and you will gift him limited shares, so he has zero say in how the management is ran in the business. Now, the cool thing at this point when you're gifting your limited shares to your son is that limited shares are generally less valuable, at least from a financial perspective. They're less valuable than general shares, and that's because they don't get any management say-so with their limited shares. So of course they're not going to be as valuable. Now that may seem negative at first. However, the good side is that you can actually gift a higher percentage of shares to your son without actually hitting the gift tax threshold. And that's great if you want to give it to him as time goes by and give him a little bit higher percentage each year. Another aspect of it is that you can still maintain full control even with only 2 to 5%. I would recommend staying closer to the 5% threshold, but some lawyers may recommend 2%, if you want to cut down. But I would definitely speak to a legal advisor about that, not just a CPA about that part. Now, moving along here, another great aspect of a limited partnership that you don't get in an S corporation or C corporation is that you can actually allocate the profits in a custom manner, meaning it doesn't have to be equal profit sharing. It can actually be allocated at how you have it designed in your contract as you set up your limited partnership. Now, with a limited partnership, you might have limited partners that invest different amounts. You might have a general partner that doesn't invest anything, and you need everyone to get paid in certain time frames and not all at the same time. So you can set up, maybe if someone invests $5,000, someone else invests $10,000, and you can set it up to where the $10,000 investor gets paid off within the first year or the first $10,000 of profit. And then you start paying down the $5,000 investor. Something you want to keep in mind, though, is that with a limited partnership, and I believe even an LLP, there must be an end date in mind, or possibly even a tripwire event. So maybe you hit a certain threshold financially, and you guys decide you're going to separate, or maybe the business is failing, and you guys have a tripwire for how badly the business needs to fail before you guys call it quits. Either way, you need an exit strategy, so to speak, for your partnership. You don't want to just keep it going forever, because partnerships are not meant to last forever. Alrighty, let's go ahead and keep moving down the list here. So next on the list is the S corporation. Now, as I mentioned earlier, the S corporation is a tax structure, not a legal structure. However, there are still legal advantages to an S corporation, and that is because of the fact that you have to set it up in something with a legal advantage. So an S corporation will be set up in either an LLC, a C corp, or a B corp, and then taxed as an S corporation. You won't be able to set it up in a sole proprietorship because that's just not allowed. However, it is not a legal structure in itself. The tax advantages, well, there's going to be several tax advantages, which is why it's being so highly promoted by EAs and CPAs and other tax professionals. And it actually makes a lot of sense. So, if you do qualify for this and you are making enough profit, then by all means, go for it. Just check with your legal advisor and make sure that you are adhering to all the rules of an S corporation. And we'll go over a few of those in just a moment. And there's going to be a lot that I can't go over. There is I can't remember how big the book is. I want to say it's 1,500 pages, but it could be more, could be less. But it's going to be a long book about S corporation, and that's going to have everything you need to know. And obviously, I don't have the time to go over that in this video. So I've already mentioned it can be set up through a C corp, LLC, or B corp. Payroll and self-employment tax advantages. So you're not going to pay the self-employment tax advantages that you would in a sole proprietorship. And remember, these are both the same type of taxes. It's just one is double the other. So self-employment tax is 15.3%. Payroll is 7.65%. You will still have to pay payroll taxes because you still have to pay yourself a fair wage, a reasonable wage, I should say. Now, by reasonable wage, what the IRS is looking for is, are you paying yourself enough to cover what it would cost to replace you? And let's say you own a doctor practice and you have another doctor in your office, and you're paying your other doctor, and you know exactly what you need to pay yourself in wages, because you would just basically match what you're paying the other doctor, assuming you both have the same credentials and you're both practicing the same type of medicine. You would pay yourself the same wage that you pay the other doctor. Now, anything above that can be paid through distributions, which is not subject to payroll taxes. So you're going to save that 7.65% plus the 7.65% the business side has to pay. However, the difference is going to be that whatever you do pay yourself in payroll wages is going to be tax deductible for the S corporation, and then anything that you pay yourself over your own payroll will be paid in distributions, as I mentioned earlier. But distributions are taxed at a lower rate, generally speaking, than earned income, such as wages, and they're not subject to payroll tax. So you're really saving a lot of money in tax in this situation. Next on the list, we have here the limited to 100 shareholders rule. So you have to make sure that all of your shareholders, there's a few things actually. So the shareholders, obviously 100 or less, all of them must be U.S. residents or eligible to own S corporation shares. So what I mean by that is there are exceptions to foreigners that are able to pay taxes in America. They can potentially own shares of a corporation, S corporation. Now, if you decide to own your S corporation through a trust, there's only certain trusts, and it's very limited. Only certain trusts can own shares of an S corporation. Now, if you fail to meet some of this criteria, you could accidentally trigger the S corporation to switch to a C corporation automatically, and it's going to take about 5 years or more before you're eligible to change it back to an S corporation. So things to keep in mind with that, and this is the part that a lot of CPAs and EAs don't take into consideration, and that's because they're not really trained on the legal side of it. They're not really trained on the limitations of the legal side of it all. However, If you can qualify for an S corporation, in most cases, this is going to be a great option because you will potentially save a lot in taxes. There is a separate tax return, so that's a little bit of a drain, but it's going to be so worth it. If you can save $10,000, $20,000 a year in taxes, that tax return will pay for itself easily. So don't let that stop you, but it is something to keep in mind. There is a separate tax return. Just like with a C corporation, there's going to be a separate tax return. Alrighty, let's keep moving down the list here. And next on the list is the LLC, which, as I mentioned earlier, is my favorite one along with the LP. And the reason why is because of the tax structuring options. Now, it is a legal structure, not a tax structure. However, it does come with the advantage of being able to be taxed as a sole proprietor, a C corporation, an S corporation, or a partnership. Now, I mentioned earlier that a partnership is not a tax structure, and that is still true. However, you can set up the LLC to be a partnership, and it will distribute tax forms accordingly to each partner, and each partner will file their own tax returns, of course. So the cool parts about this are you can obviously be taxed any way you wish, but it's also a fairly safe entity to set up, especially if it's a multi-member LLC. Now, if it's a single member LLC, the IRS, unfortunately, they call it a disregarded entity, and you will hear CPAs and EAs and other tax professionals call it a disregarded entity. However, please don't get that confused with an asset protection disregarded entity, because it is still very regarded as far as the court system goes. You want to make sure that you don't let that deter you from setting up an LLC if you are a single member. However, as a single member LLC, you do want to keep in mind that you probably want to avoid several states for setting up your LLC, and that's because they have weak protection for single member LLCs, and the weakest state would be California. I'm not saying you should avoid setting up an LLC in California just because they're the weakest state, but you probably want to create a completely separate LLC for California, even if the business you're doing is the same as another LLC you have set up in another state. So one example here is that, let's say you have a LLC set up in Wyoming and you're trying to foreign qualify, which means your Wyoming LLC is trying to do business in California. I would recommend that you just start up another LLC and just have that extra distance between your LLCs here, because California law is a little wonky and they kind of make up their own laws, and they could even say that Wyoming law has no precedence. However, everywhere else in the country, Wyoming law, if that's where you formed your LLC, then Wyoming law is where the court will hold the legal aspects of your company liable. Now, that doesn't mean that if you do something wrong in another state, you're not going to be liable. What that means is that they will treat it and I guess distribute punishment, so to speak, consequences, I should say, based on Wyoming law. And now, as I have it right here, safest states for single member LLCs are Wyoming and Nevada. I've also heard that Delaware is pretty good even for single member. Delaware is usually used by larger corporations and LLCs, but I've heard it's pretty good for single member as well. Colorado and California are two of the weakest I've heard of. And the reason why Wyoming and Nevada are the strongest, and of course I mentioned earlier that Nevada has strong protection for C Corps that are single member, single owner, and it's the only state. The reason why these two are so strong is because of the charging orders, and I brought that up with the C Corp earlier too. The charging orders, let's say in Wyoming, if you have your LLC set up in Wyoming and you have it foreign qualified to do business in another state, and you get sued, let's say you get sued, Wyoming is going to say that you're only going to have to pay based on distributions, a percentage of distributions from your Wyoming LLC. as opposed to other states where if you lose a lawsuit, then the plaintiff could potentially take over your LLC and own all the assets in the LLC. Wyoming and Nevada say, no, you can't have the assets, but you can have the distributions or a portion thereof, future distributions. I'm not saying you should go this route, but you could potentially just cut off distributions. Stop giving yourself distributions from these LLCs. And like I said, I'm not saying you should do that. However, I know that there are also a lot of frivolous lawsuits out there, and this is just one way to protect against those. Now, if you are liable or your company is liable or responsible for something that happened to someone ethically, well, we don't need to get my personal beliefs in here. However, you should keep that in mind as well when you're making your decision on whether you want to cut off distributions or not. Next, you must keep personal expenses separate from your business expenses. Now, that's going to be true with all the entities. Even in a sole proprietorship, I would highly recommend it. Now, a sole proprietorship, and not an LLC taxed as a sole proprietorship, but an actual sole proprietorship, you can intermingle, and it's not going to be as big of a deal, but I would still highly recommend separating them, even in that case. And I would even say, get an EIN for your sole proprietorship and get a separate bank account and only charge things to your business account that are for business purposes and only personal things from your personal accounts. So back to limited liability here. With an LLC, you'll want to get an EIN. Now, it's not required in a single member LLC, but if you don't get one, you might as well not even get an LLC. I mean, if you're going to be doing business with your own social under your LLC, there's not really much point in having the LLC, because the whole point of the LLC is to provide protection. And when you start intermingling your personal aspects with your business aspects of your life, then you set it up so that the corporate veil can be pierced. And what that means is people can get at your personal assets based on what your company does and vice versa. So just make sure you get your EIN, treat it as you would a C corporation. The only difference being if it's single member, you're going to have one tax return. But other than that, treat it as much as possible as its own entity. Next, let's just keep going down the list here. And here we have trusts next on the list. So I didn't want to spend a lot of time on this one, so I didn't create a slide because I don't really know that much about trusts, and I don't want to act like I do. Now, I do know it's a tax structure and a legal structure. So it's a tax structure because you can find it on the W-9 actually as a tax type, but it's also a legal structure because it is an entity of itself where assets can be allocated or even protected. If there is no allocation, you can specify much more specific instructions on how the assets are allocated. And it also provides a good tax shelter for estate planning in many cases. So it can either lower or even fully eliminate estate taxes when items are being distributed upon someone's death. Next, let's continue down the list here to B Corporation. Now, a B Corporation is the newest entity type on the list here, and it stands for Benefit Corporation. It's actually the same as a C Corporation, the same setup as a C Corporation, just with a different set of priorities. So like a C Corporation, it can be taxed as a C Corporation or an S Corporation. However, as I mentioned, the priorities are different. So what that means is that in a C corporation, shareholders and their profits are generally put first, their top priority, above anything except for, of course, legal liabilities and legal regards. They have to be law abiding, of course. But in a benefit corporation, they tend to put the environment or humanitarian or even employees first above profits. Now, they still try to earn a profit for shareholders. They're not nonprofit. They do try to earn that profit. However, they're not shareholders are not top of the list like they are in a C corporation. Now, in a benefit corporation, If a shareholder tries to sue them for not putting them first or for putting something else above them, it's not going to work out. And that's the whole purpose of the B Corporation, is to provide that protection from shareholders so that they can actually do better for the environment and do better for the community. That does not mean that they have no obligation to the shareholders. However, they still need to try to make a profit, at least. Again, it's the newest entity, so there's not a lot of case law out there for it. So not a lot of court cases, and not an exact threshold for how much is owed to the shareholder and how much is owed to the environment and community. Now, this entity isn't actually formable in all states. So at the time of this recording, I believe there are 29 states that currently allow this formation in their state, and there are 14 other states that are currently considering allowing this formation. So there's still a few states that just aren't even considering it and don't have it at all. So I'm not sure what that's going to mean for foreign qualifying in another state. As I mentioned before, foreign qualifying just means registering to do business in another state as that entity. Let's take a look here at the list. I just wanted to show you the states that it is eligible in and the ones that it is currently being considered in. Alrighty, ladies and gentlemen, moving along to the last entity on our list here, nonprofits. So nonprofits, as you could probably already tell, are not set up to make profits. They are created to better the environment, some type of humanitarian effort, or just the community in general. It can be set up as a corporation or a trust, and it can have multiple owners. It doesn't have to have just one owner, of course. Now, I put on the list here that it pays low to no taxes. You may think it pays no taxes. However, there are certain circumstances where they still have to pay taxes. In Hawaii, for example, we have general excise tax instead of sales tax. And on certain items that you may get from a nonprofit, let's say you go to an auction, a nonprofit auction, and you purchase something through the auction. Now, the nonprofit has to pay GET on any items they sell at the auction. And the reason why is because it's not a pure donation. Now, if it was a pure donation, no GET would need to be paid. However, since there is an exchange of something, you're getting either gift cards or 3-night hotel stay or whatever the package is that you won through the auction, there is an exchange. So you're getting something for your money. And on those type of quote-unquote donations, they do have to pay general excise tax, and they are also allowed, of course, to charge the purchaser for that GET, and in most cases they do. I know I've been charged for it. Alrighty, that's all I have for you today. Thank you very much for watching the video all the way through, and if you have a chance, please stop by tinkertonllc.com and check out the website. We do collaborative bookkeeping. What that means is we actually work with your team of advisors as well as with you. We don't just do the bookkeeping behind the scenes. And if you have any questions or even feedback about the website itself, that's fine too. Just reach out to me via the website contact form, and I'd be happy to hear from you guys. And thank you again. Aloha.